So, all right, let's talk about some banks here. Actually, one bank. We're going to look at Bank of America. Their symbol is BAC, and I didn't know this. They're not a money center bank. They're a bank diversified. I guess that's because they still own Merrill Lynch and some other things, I think.
Yeah, I mean, maybe sometimes the industry changes depending on what
Yeah.
software program you're looking at, but
I'm not certain, but I'm pretty sure like JP Morgan Chase and Citibank, I think they're still in the money center banks, but I could be wrong. So, all right. Well, on the short side, it's only 1.5%, 68% institutional owned. That means a lot of individuals hold the stock directly. We do see a PE ratio of 14.4 versus 10.6. That's not good. Again, you want these valuation ratios lower than the industry average. Price to sales for Bank of America, 3.8 versus 3.2. Price to book value, 1.4 versus 1. And then price to tangible book value, this is better, 1.8 versus 5.6. It shows no price to cash flow, unfortunately, but they do have a PEG ratio, which is your price earnings divided by the growth. 1.2, that's pretty good. Nothing for the industry average. Now, over the past year, wow, their earnings are up 23.6%. That's above the industry at 15.8. Sales for Bank of America climbed by 6.1%, almost nearly double the industry as well at 3.7. The 5-year earnings per share growth estimate from the analyst looks pretty good for Bank of America, 11.1 versus a decline of 6.9. They do pay a dividend. It's not as big as the other banks. It's about 2.1%. The industry pays a 3.9% dividend. The payout ratio for Bank of America is 30.1%. So they could probably increase that if they wanted to. We do see, let's see here, on the quick ratio, current ratio. Oh, banks are not going to have those. Again, it's a financial company like an insurance company. But you do have the debt to equity, 1.2 versus 1.9. We also see that you have a net profit margin for Bank of America of 26.9. That is below the industry average at 29.9. Return on equity is low, 8.9. Usually on banks, it's lower than return on invested capital, which includes your debt. 16.9 is the return on invested capital versus 15.7 for the industry. Free cash flow is a negative 22.6 versus a positive 24.6 billion for the industry. And Chase, what do you got for the company going forward here?
Yeah, current price here to start for Bank of America is $52.57. 52-week range, the low here, $33.07, and the high, $52.88. Year to date, it's done very well, up almost 20%, and 5-year return over 100%, 10-year return 208%. I don't have the ability now to kind of dig deeper into this, and I don't know why it wouldn't be accurate, but I look at the max chart on this, it's 53%. I mean, going back to
what? 53. Yeah. 5,300 or just
53%. Back to 1995, if you would have bought back then, you're only up 53%. And it looks like in like 1997, its all-time high was like $60.13. So it doesn't even look like we're back to that all-time high. I didn't know that for Bank of America, unless this chart is leading me astray.
I do remember back in the 90s, there was a banking problem. I remember at the time we sold Citibank at a pretty good price, and it dropped dramatically. So I think this could have been, with a change with them, they came out maybe at the peak, and that's why now there's 53%, and that probably does not include dividends.
No, it does not include dividends.
Because I do see the 10-year return on the dividends, which, again, this points out how important dividends are, but it's 304% with a dividend. You said 10-year return was what, 200 something?
111 or
what?
something. No. Oh, I'm sorry, that was the 5-year return.
Yeah, 10-year without dividends was...
You always do this to me. You always throw me for a loop after I moved on to different numbers.
Backwards.
Let's see, 10-year return, 208%.
Yeah, so dividends make a big improvement for people.
Yeah, well, let's look at what we're paying for those future earnings. We got to December 2026. I see estimated earnings per share $4.34. That would give us a target sell price of $72.04. The forward PE is right around 12 times. So, I mean, it is a buy based off the valuations. And I still think I wouldn't be over concentrated in the financial space, but I think having one of these big banks in your portfolio, again, you talk about a JP Morgan Chase, a Citigroup, Wells Fargo, Bank of America. I think having one of those in your portfolio, it still makes sense. I think it's not too risky to put one in there, but I am starting to, again, have some question marks around the financial industry, but there is still some positives remaining as well. If the economy continues to move along quite well, banks will do nicely.
Well, I know for, 2008, I mean, since about that time frame, I pretty much held in the portfolio 2 banks. But as we talked about earlier in the show, so important with this NFIDs, private equity, private loans. I'm getting a little bit concerned on the banking industry. And the numbers look okay. But again, we talk about how those numbers could be masked by people that are just hyping up what they have.
And the other thing I look at, I mean, the numbers right now, as you said, very good. I mean, you look at Bank of America, they earned $1.06 per share. That beat the estimate last week at 95 cents. But one thing that's really kind of pushing these banks higher is strong investment banking revenue. And is that going to continue next year? We're going to continue to see the IPOs. We're going to continue to see M&A. If that slows, that could, again, reduce the revenue and reduce the profits for a lot of these big banks as well. So that's why, again, I want to be cautious around the space, but I wouldn't say eliminate the space as well.
Right. Be very careful here because, again, we talk about a lot that comes from M&A, which we talk about new companies coming out. A lot of them have done well, but I actually saw, I don't know who, maybe it was CNBC. They showed a chart. A lot of these companies coming out, they go up and then down many times back below what they came out the IPO. So we're having more of that. So if that starts caving, they're not going to have the M&A.
They will have the IPO. They might still have M&A where companies buying.
No, usually that slows down too because they kind of get a little bit concerned. That generally cuts off the whole market. So everybody gets scared. They don't want to do anything. So.
I might disagree. I don't know. The M&A might still hold up all right because of the regulatory environment. People might still say, hey, we got the current administration that's looser on regulation. We want to push through M&A because we don't know what's going to happen in next year if the midterms don't go well. So I think M&A might be okay next year, but the IPO market, that might slow because of, as you said, if it's going up and then it's going down. I mean, I'm not going to IPO because it's not that healthy of an IPO market in theory.
Yeah. I just get scared all the way around when things start collapsing. And then we talk about the NFIDs. That can hurt to where it can just hurt everything, and all business will start slowing down. So you just want to be careful with the banks. I mean, we're pointing out things that, and again, we do hold 2 banks in our portfolio. We may lighten up on one next year. We're kind of getting a little bit concerned. We made huge profits since 2008, and it's just something that we're starting to be concerned with how loosey-goosey, that's a technical term, loosey-goosey things have gotten. So
very technical.
Yeah, very technical.